Good morning and welcome to an East Capital Group webinar. For those of you who don't know me, my name is Massimo Grassotti and I am part of the investor relations team here. Today we shift away from equities to talk about another asset class that has been increasingly growing with regards to interest, and that is corporate bonds, more specifically Nordic corporate bonds. To help talk about the subject, we've invited Anders Borg, renowned former Minister of Finance for Sweden, alongside Stefan Pari, who was Senior Portfolio Manager at Espiria. Now, over approximately the next 20 minutes or so, with help of both Anders and Stefan, who will share their expert opinions on why this is an asset class we should be paying attention to, and also why the Nordics are such an interesting market. So, Anders, if we start with you. Now, it's been a very interesting and eventful week. We've had Fed, ECB, earnings. If you could just quickly summarize this for us and give us a feeling of what the message was.
Well, I think it's clear that we've seen a fairly large shift in the central bank stance. Governor Powell was clearly indicating that a disinflation process in goods have begun. Fed has now 5 or 6 good inflation numbers under the belt. They have seen market inflation expectations come down. We have a more moderate pace of wage increases, and all in all, this together gave Powell to the confidence to actually conclude that we are starting a disinflation process. Fed is getting 2 more CPI numbers and 2 more non-farm payroll, one today before we have the meeting in March. If we would see a continuous disinflation process, I think it's actually an open question whether Fed will leave rates unchanged in March or even just do a 25 bips and then declare, as Bank of England and Bank of Canada already have done, that the rate hikes are now reached a peak and that they will keep the rates at this level until inflation subsides, but that we basically are in a new phase of monetary policy. And I also think that ECB, they hiked 50 basis points. They make clear that they have the intention to do another 50 basis points at the next meeting. But Madame Lagarde also stated that the risks are more balanced today than they were 3 or 6 months ago. So I think we are in a much more comfortable situation, particularly looking at the risks. It's clear that we're not getting a gas recession in Germany. Storage levels have come down a bit, but it's clear that the industry will be functioning over this winter. The risk that monetary policy would push the US and Europe into a recession have subsided. PMIs and many other indicators show that demand has actually been fairly resilient. And on top of that, the opening in China obviously means that global demand is fairly strong. So IMF, for example, revised their forecast up this week. They increased growth expectations for China with almost a percentage point. So yeah, I think the overall picture is much better than it was just 6 months or so back. Obviously, the earnings season for Q4 has indicated that there is a lot of pressure on not so much the top line but the bottom line. So margins are under pressure. But I'm not sure that we should be so worried about this because most companies are during Q1 implementing cost-cutting programs. When demand comes back, when we actually see real wages started to increase again in the, let's say, 3rd or 4th quarter, I think many corporates will be in a position where they will catch up on margins and that we therefore could be slightly more optimistic on earnings growth going forward. So overall, I think the risk of stagflation has come down. Clearly, the central banks have hiked rates, but they will not go to excessive tightenings. It seems like the economy is fairly resilient, so we don't get a recession. I think this is a much better environment for the stock market and other assets than we've seen for a couple of quarters at least.
Great. Nice to hear that you sound positive from that aspect. If we then take that one step further and we look at then the Nordic bond market, right? It's unique in a lot of ways and it does offer very attractive opportunities. For those who aren't quite so familiar with it, could you point out and highlight a few of what are the options and what are the ideas that make it so unique and so special?
Well, One has to remember that the Nordic region is very strong. Growth have over the last decades or so been stronger than in the rest of the Eurozone. There are some fundamental reasons for this. The industry is very competitive. If we look at companies like Volvo, Sandvik, Atlas Copco, they are at the cutting edge of technology. They are backed by very strong owners. They also have very strong balance sheets. Many of the Nordic companies have a EBITDA to debt level that is well below 3. And some companies like Atlas is actually debt free. So it is a dynamic region that is also supported by a very strong entrepreneurial climate. You probably all used Spotify. You've heard about Klarna. You might be on a Skype call on and off. There is a lot of successful technology startups in the Nordics. So there is a strong dynamism, and there's also been very substantial labor market and welfare state reforms over the last 2 or 3 decades. Pension systems are generally already reformed. Unemployment benefits have a very strong driving force for staying in the labor market, and we have very responsible unions. So wage setting in the Nordics is, I would say, much more responsible than in the rest of Europe. So this implies that we are probably going to see much lower wage increases in Sweden and Denmark and Finland and Norway than in, for example, Germany when we're looking for 23-24. There is also a very high degree of stability. I mean, it's well known that public finances in the Nordics are strong. Sweden is heading below 30% of GDP. Denmark is in the same neighborhood, and we all know that the oil fund makes Norway a kind of a special case. On top of that, the banking system is also very stable. We have pushed up core tier 1 capital substantially higher than in the rest of Europe. Many of our banks have capital adequacy ratios of 16, 17, or even 18%. They are also fairly profitable. ROEs in Sweden are and the rest of Nordics are almost always north of 10%. We actually saw one Q4 result here at the 15% ROE result. Cost income ratios are normally well below 50. So the combination of strong public finances, a very resilient banking system, large current account surpluses, well anchored independence for the central bank makes this into a fairly stable region. And this combination of dynamism, growth, and stability makes it a very attractive market because many of the companies in the Nordics have gone into the bond market over the last few years. It is a fairly large and deep market, but there are also other features that makes it very interesting from a bondholder perspective. And I think Stefan Pari is one of the best experts to explain why the Nordic markets is so interesting for as a corporate bond investment.
Well, that's great. Thank you, Anders, and thank you for setting the scene, which is then perfect because we have our expert right here, Stefan. Thank you very much for joining us today.
Thank you.
So if we dive right in then, I mean, tell us a little bit about this new fund.
So it's a new fund launched in December last year, but it's based on a segregated account we've had for many years. And we've seen that it has performed during a risk-off environment like 2020 and 2022, and during risk-on environment like 2021, where we have generated a good performance, positive performance in both. Well, all 3 years, and we like the Nordics. We sit close to the companies we invest in, and they know who we are, and we know who they are. And on top of that, we have wider spreads in the Nordics compared to Europe and in the US, which makes the expected return will be slightly higher.
Good. If we touch a little bit more on what you just said there, risk and opportunity, what's the risk appetite like right now?
Right now, the risk appetite is good. We have strong markets, and a reason for that is obviously the higher interest rates and the credit spreads that are elevated. But we also see that bankruptcy risk is also getting higher due to the fact that interest rate is getting higher, which is making it difficult for some companies to generate enough profit, and it's also something that will hit some companies through the households when they don't spend the way they have spent the last couple of years. So that's, yeah.
I mean, so, you know, we spoke in market now, and if we look a little bit more directly at the actual strategy and actual fund, you have a very unique process, right? And there's a lot that makes the way that you work very special. You know, I mean, you do your own credit analysis. Elaborate why it's important, please, and also why that gives you an edge.
Yes. So first of all, 75% of the high yield universe, the issuer there, are unrated. So it's important to be able to do your homework and try to understand the credit risk and assess it in a way that will generate an alpha. And we have that process in place. We have a model, and it's proven to work both in good and bad times. And we also has a system where we do a quality assessment, as well as just a credit assessment and a sustainability assessment, and we score that in order to get a more full picture of the risk and possibilities when we invest in the bonds. And I think especially our EQSs, our quality and sustainability scoring is something that is very unique, and the fact that we are fundamental based investors that are actually doing the homework.
Yeah, I mean, something that we do mention, and because the Nordics are very unique in their sense, there's this with the floating rate notes. We can't forget to mention, right? That is a very key component. Describe that a little bit more for us.
Yes, so the majority of the investment we are holding are having a floating rate note, which means that they are paying a coupon 4 times per year, and we have a reset, which means that the price volatility of the bond will be lower. So the interest rate duration in general for those kinds of bonds is 45 days, compared to, for instance, a fixed bond that might be 4 or 5 years. So it's a large difference when it comes to interest rate risks.
Yeah, and I can imagine now, as we are hopefully starting to reach, you know, maturity at the top of our interest rates, that resetting every 3 months does help.
Yes, so that is actually a big difference when it comes to a raising interest rate. We will actually benefit from it with a lag of 45 days. Then we will get a higher coupon rather than you know, have a negative effect on price that we saw in continental Europe, for instance, last year.
Yeah. Moving into that a bit more, so tell us a little bit more about the construction of the portfolio. How does it look? High yield versus investment grade? What else do we need to know?
Yeah, so the mandate itself is quite flexible, but we invest predominantly in high yields, but in the safer part of the high yields, due to we forecast credit metrics to deteriorate for many companies. We try to avoid companies that are negatively affected by household spending drying up. We are not having a large position in the real estate sector at the moment, because we think the uncertainty still is a little bit too high. What we do have a large position in is in banks, and then the big banks in the Nordics and insurance. So I would say that in general, compared to a high yield fund, for instance, I would say that our credit risk is a little bit lower, but that's just because we expect credit metrics to worsen during this year.
Yeah. Anders touched a lot about it with regards to the market itself, and that we have a very strong supportive system here. We have 3 out of the 9 AAA rated countries, correct?
Yes.
In the Nordics. Could you touch on that a bit more?
Yeah, sure. So both Sweden, Norway, and Denmark is AAA rated by both S&P, Moody's, and Fitch. and there's only 9 countries in the whole world that is AAA rated by all 3 major rating agencies. So that's obviously a plus if we would go into a recession, because then we have very much firepower in order to stabilize the economy and help people and companies survive during a prolonged period if necessary.
Yeah, great. Well, thank you very much, Stefan. Thank you very much, Anders, for joining us as well. Thank you to everybody who called in. If you'd like to hear more from Stefan or Anders, or with regards to any of our other strategies here at East Capital Group, please do not hesitate to reach out to any of us. We're always happy to help and set up meetings. Until next time, thank you.